Thanks very much, and thanks for the invitation. Thanks to you all for spending your lunch break listening to me. This piece of work is, there's a report or a paper up on the ESRI website, and it was that we presented it as part of the annual Budget Perspectives Conference that the ESRI has. So myself and Darren there were just talking about how some of this might seem out of date, but actually, while we're looking at a specific point in time of the pandemic and the implications for people, really, I suppose what we wanted to do was to learn sort of more general lessons from the pandemic for the social welfare system. And as Darren mentioned, this is work with Karina Dorley and Dora Tuda of the ESRI as well. So just by way of introduction of what I'm going to talk about today, I'm going to talk about the effect that COVID-19 had on employment and incomes. I'm going to talk about the very significant and large and very quick government response to support incomes. So despite the fact that we had pre-existing welfare supports, we've seen additional supports rolled out. So I'm going to dig a bit more into, why is it we needed those and what issues that they highlighted. And then we also examined the income shock as a result of COVID and how much the newly introduced measures, so these additional welfare supports, helped to reduce the income losses that people would have faced in their absence. And then I'll finish up by just discussing some gaps in the social welfare system that have been highlighted with the pandemic. And I'll also mention some potential reforms. And in large part, that's driven by the fact that these schemes are sort of in the middle of winding down. Or already have been reduced. So we'll have a look at sort of, who are the groups that are going to be most affected by those withdrawal of the schemes if recovery isn't as prompt as we might like. So in terms of the employment impact and policy response, here I'm just showing the unemployment rate. So the black continuous line is the overall standard unemployment rate. The blue continuous line is the youth unemployment rate, 15 to 24-year-olds. And these dashed lines here are basically showing, it's what the CSO call the COVID-19 unemployment rate. So basically, they categorize absolutely everyone who receives the pandemic unemployment payment as being unemployed. And the reason I suppose the CSO produced these two different series is that there are some people who are receiving the pandemic unemployment payment who traditionally wouldn't be unemployed. And I'll explain a bit more about who those people are in a moment. So what we can see, first of all, is that if we look at this black dashed line, the overall unemployment rate, shot up to over 30% at the onset of the pandemic and has, came back down as restrictions lifted and then tended to go back up as restrictions increased. And another feature that we see of this is the blue dashed line. So this is the youth total unemployment rate. So the youth unemployment rate, going to well above 60% at the onset of the pandemic. So really high youth unemployment rate. And this is quite common. If we look back over time, we see over the Great Recession that the youth unemployment rate tends to increase more sharply. And I suppose an interesting feature is that the youth unemployment rate really hadn't recovered, before the pandemic to its sort of pre-Great Recession times. And unfortunately, we're seeing that again, young people are more affected by unemployment during the pandemic as well. So in terms of the policy response, we had the first lockdown on the 12th of March 2020, and there was quite a swift government response in that there was the pandemic unemployment payment announced on the same day. So the pandemic unemployment payment was initially announced at €203 a week, and that's in line with the pre-existing unemployment supports, things like Jobseekers Assistance and Jobseekers Benefit. What we saw then was that there was sort of calls that, this €203 was not sufficient, and that there should be some sort of linking back to previous earnings. So what we saw is that, rates throughout the pandemic have tried to respond to sort of lockdowns and reopenings. So first of all, an important feature of the pandemic unemployment payment, and that differs to pre-existing unemployment supports, is the fact that it's linked to your income. So it ranged from €203 to €350 per week. The rates at the moment, I suppose the aim is to bring down, before abolishing PUP entirely, is to bring the rates down in line with the pre-existing job seekers allowance and job seekers benefits payments. So there's been reductions in September 2021 and November 2021 as well to try to align these rates more closely to the pre-existing unemployment supports. So I suppose in large part, those additional rates were brought in because it was recognised, or it was, government was acknowledging that the rates of unemployment supports that were there beforehand weren't sufficient. So that's even a sort of interesting concept in itself, that we were saying, okay, well, people who lost their job before the pandemic, that €203 was sufficient for them, but somehow, people losing their jobs during the pandemic, that wasn't a sufficient amount. So that sort of brings up, a lot of interesting discussions for the social welfare system at large. In terms of wage subsidies, the temporary wage subsidy was brought in March 2020 and was replaced by the employment wage subsidy on the 1st of September 2020. And basically, this is a subsidy paid to employers if they keep eligible employees on their payroll. And companies were eligible for this wage subsidy if they had lost over 30% of their turnover. And really, this is, still very topical, this issue, because the wage subsidy, it's due to be withdrawn in December 2021. But in light of the sort of increased restrictions we're seeing more recently, there's a lot of debate, and it looks like government's probably going to extend out the wage subsidy. And I suppose a positive thing of the wage subsidy over the pandemic unemployment payment is that it keeps people linked to their employers. So we know if people are out of work, there's potential wage scarring, and they may be more likely to stay in longer term unemployment relative to people who at least keep some link with their employer. So in terms of PUP recipients, we can see here, if we look at the overall red line, that's the total receipt of PUP. Here I've just broken it down by age group, so those over and under 25. We can see a sharp enough rise to over 600,000 people getting PUP at the onset of the pandemic. It came down quite a lot as we entered into the summer and lockdowns and restrictions lifted. And we see then again, going up and down in line with restrictions. So this is up to May of this year. We do know it's come down in recent months, but it could potentially increase again if the current restrictions end up causing more job losses or that people can't get back to work. The wage subsidy, so we see at the peak of it, just over 450,000 people's incomes being supported by the wage subsidy. Again, we see that it increased sharply at the onset of the pandemic, sort of comes down a bit as we come out of lockdowns, but then tends to increase again. So here we have the sort of last Christmas, which is feeling very much like this Christmas at the moment, and increases in the numbers on the wage subsidy. So it's really linked to sort of lockdowns and restrictions. I think the latest figures I saw was that in total, we've got around 630,000 people on either the wage subsidy or the pandemic unemployment payment. That may have improved slightly though in recent months. So in terms of the distributional impact of COVID-19, we examine basically the income shock that people suffered as a result of COVID-19. And then we also, in the piece of work, examine work incentives. So there was big debate at the time, was PUP too generous? So on the one hand, we had people, saying it's not enough and it needs to be linked back to your earnings. And then we had others saying, well, it's creating work disincentives, it's too generous. So we'll have a little look at that issue. In terms of how we calculate the distributional impact, so of course, one of the main problems that economists and researchers tend to face is that data always comes with a few years of a lag. So I think the latest data on incomes would be the Survey of Income and Living Conditions from 2019, which of course is well before the pandemic. So how do we calculate the distributional impact? Well, we use Switch, the ESRI tax benefit model. The model, we've just updated it, but at the time of this analysis, it was based on 2017 data, and we adjust up incomes to be representative of 2021 levels, so sort of adjusting by wage inflation between 2017 and 2021. And then we, of course, have to implement our job losses, this big shock to people's employment. So what we do is we use administrative data from the CSO that tells us what proportion of each industry lost their job as a result of COVID. And we basically simulate those job losses. So we take a certain proportion of people from each industry and we basically force them into unemployment. And we've checked to see how that fares with administrative data on the sort of the age, gender, income profile of the people who lost their job, and it really, it really calibrates quite well. And there's some information on that in the paper. And then we assume that a certain proportion go on to either the pandemic unemployment payment or the wage subsidy. And again, the numbers, we calibrated this to numbers from August 2021, I think it was. So unemployment was higher back then. But in general, I suppose the distributional impact shouldn't change hugely unless there's a very significant recovery. And then the model allows us to examine the income losses that people would have faced in the absence of the pandemic unemployment payment. So basically we can implement the scheme or not and the wage subsidy and see how much would have people lost out. So we know that obviously people who lost their job would have faced very large losses to their market income, but there was already, sometimes when we talk about the pandemic, we sort of, think of PUP and the wage subsidy as being the only supports. A lot of people who would have gotten PUP or the wage subsidy would have been entitled to pre-existing income supports. And I'll talk a bit more about the people who wouldn't have been. But we wanted to see, how well would the pre-existing welfare system have supported those people's incomes. So here I have the distributional effect of the pandemic related job losses. So we ranked people from quintile 1, the lowest income quintile, up to the top income quintile. And I'm showing you the percentage change in disposable income that people would have faced if we had the COVID related job losses, but there was no additional policy response. So the pandemic unemployment payment or wage subsidy weren't brought in, but the pre-existing schemes, things like job seekers allowance or job seekers benefits kicked in for people. So what we would see is that overall, I suppose the losses are progressive, and that in general, they're more sharply felt at the higher end of the income quintiles. We see at the very bottom quintile, actually a very, very small gain in income. And the reason there's a gain in income here is that there are some people down in this positive quintile that are actually financially better off not working. So their wages are so low that they'd actually be better off on the pre-existing unemployment support. So it's a very small effect there. And then we see in general that losses increase as we go up the income quintile. Quintile 5 protected maybe a bit more than other quintiles, reflecting the fact that the sort of industries people are working in, more people, I guess, in quintile 5 are higher income and maybe more able to work from home. So they were slightly more protected. But overall, we would have seen around a sort of 7% loss in income if there'd been no policy response. And then we added in the effect of the pandemic unemployment payment and the wage subsidy. So this is represented by the purple bars. So first of all, what we see is that overall, the loss is more than half. So there's still a significant loss in income of near 4%, but it's half of what it would have been in the absence of these payments. And if we look at the distributional pattern, we see an even larger gain for the bottom quintile due to the introduction of these schemes. So this is perhaps supporting a little bit the notion that the pandemic unemployment payment for very low income people, it was more, maybe more generous and topped them up to higher benefit amounts. So there's a small gain in income at the very bottom, reflecting those people that are better off out of employment than in employment. And I suppose it's sort of interesting to think of those people as well, because, before the pandemic, they were in employment, even if they were better off not working. So, financial incentives to work are not the only reason that people might be in employment. What we also see as well is that for every quintile, each quintile is protected relative to the pre-existing benefits that were there. Particularly, we can see, a sharper sort of gradient come out. So quintile 5 still losing significantly, but really significant income protection provided for quintiles 2, 3, and 4 relative to what would have happened beforehand. And that really is reflecting the fact that the pandemic unemployment payment has a stronger link to people's previous earnings. So while the pre-existing unemployment benefits were good at sheltering the incomes of the lowest quintiles, these new more pandemic unemployment payment with its wage gradient, it does even more to support or to protect the incomes of those higher up the income distribution. Moving on to the effect on work incentives. So what we did was we calculated people's replacement rates. So basically your replacement rate shows you how much, for those people who are working, how much you would get in benefits, or how much of your work income would be replaced by the social welfare system. So, and here I'm just showing, so the continuous blue line are what people's financial work incentives or replacement rates look like if there'd been no COVID policy response, so just the pre-existing unemployment supports kick in. And then the dashed blue line shows you what people's replacement rates look like once the pandemic unemployment payment is introduced. And here I've just put a red line at 1. So basically 1 means, you've got a replacement rate of 100%. So if you lose your job, your full income would be replaced by the social welfare system. So we can see, relatively small numbers to the right of this line, meaning that they're actually better off out of work than they are in work. We can see overall a shift to the right, meaning that you can read it two ways. There's either stronger income support for people who lose their job, or the flip side of that is that there's a weakening of people's work incentives in general once the pandemic unemployment payment comes in. And we can see that from, if we trace to a particular point on these lines, we can see the proportion of people who have a replacement rate at or below a certain level. So if there was no policy response, half of people who lost their job would have what we term a low replacement rate, so less than 25% of their market income replaced by the social welfare system. When we do introduce the pandemic unemployment payment, the replacement rates for around half of the population increased to around 30% or below. Still relatively low, but a bit of an improvement. Overall, if we look at people who would be termed to have higher replacement rates, and there's no exact number for this, but we've picked the figure of 70%. So 70% or more of your income would be replaced by social welfare. We have 5% of these people in this situation before the PUP is introduced, and it rises to 12% once the pandemic unemployment payment is introduced. So I suppose there's sort of, you can consider replacement rates as showing up weak work incentives, but also showing up higher income support. And that's reflecting that the fact the pandemic unemployment payment is tied back to people's previous earnings. If we look at how we fare internationally, so there's been quite a lot of debate over whether we should have a stronger link between what you were earning beforehand and at least short-term unemployment benefits. We can see that before the pandemic, a single childless person earning just the average wage has a net replacement rate in Ireland of 29%. So that means 29% of their earnings will be replaced by unemployment benefits. The OECD average is 55%. So there's much stronger income support at average wages across the OECD than there is in Ireland. Then we move on to examine, you sort of highlight the people who really, I suppose, are quite supported by the pandemic unemployment payment and wage subsidy. And the flip side of that is if those schemes are withdrawn without sufficient employment opportunities, the people who face larger losses. So here I've just got different categories. We already saw from the distributional impact that the pandemic unemployment payment is doing a better job at supporting incomes across the income distribution than the previous unemployment benefits did. If we look at other characteristics here, we show the proportion of a particular group that actually lose income as a result of COVID-related job losses. And then we're highlighting of those who lose more than 20% of their income. So who are those people who are quite reliant on these payments? The first that we can see is 18 to 24-year-olds. So while around a fifth of 18 to 44-year-olds lost income as a result of the pandemic, over 90% or 90% of those in the 18 to 24 age group would have lost 20% or more of their income if the pandemic unemployment payment and wage subsidy weren't introduced. You can see this sort of come out as well in the education statistics. So a key feature of the pandemic unemployment payment and a reason why we see, this CSO sort of debating over who should be included as unemployed is that students who lost their job as a result of the pandemic were eligible for the pandemic unemployment payment, but wouldn't have been eligible for other income supports because you can't get them if you're a full-time student. So while 13% of those in education would have lost income as a result of COVID job losses, 82% of them would have lost more than 20% of their income. And then we see as well groups like in general, the older age group are more protected because benefits tended to remain untouched over this time period and they're less likely to be in employment. Working age singles, working age couples with and without children, around 16 to 18% of these groups would have lost income as a result of COVID, but between 70 up to 87% of them would have lost more than 20% of their income. So these are the sort of groups that are quite reliant on these payments as they stand. So I suppose really what we were trying to do in this piece of work was, to examine, well, why is it we needed the pandemic unemployment payment and wage subsidy? Why were the previous unemployment supports deemed inadequate to tackle the income losses caused by COVID? So the first issue that we sort of highlight in the report is younger people's entitlements. So we've seen, as it was in the case in the Great Recession, younger people are more affected by job losses. And young people tend not to qualify for the non-means tested unemployment payment. That's called Jobseekers benefit. And that's because you have to have a certain PSRI contribution history, which often young people don't have enough of. So instead, younger people tend to be reliant on the means tested job seekers allowance. And there, if they have a partner with income or they're living at home, parental income can come into the calculations as well. So they tend to have lower entitlements to income support in general. Whereas with the pandemic unemployment payment, there's no age distinction. So those at the moment, young people under 25 who are eligible for job seekers allowance get a rate that's 45% lower than those over 25. This age distinction doesn't exist for pandemic unemployment payment. So I think the PUP is payable if you're aged 18 or over. So you get the full amount of minimum €203 relative to the lower paid job seekers allowance. So this change happened in the Great Recession. And the stated aim at the time was to ensure that young people were better off in education, employment, or training than they were claiming benefits. And if I was being cynical, I'd say as well, there was a huge financial motivation because we had very high youth unemployment at the time. So there was a lot of cost savings by reducing down the rates, the under 25 rates of job seekers allowance. So some evidence from the labour researchers in Maynooth University, they examined the cut to job seekers allowance that happened over the Great Recession. And really they found mixed evidence that the cut actually increased youth employment. So they find a little bit of evidence that the really young age group, the 18 to 19-year-olds, took up a job more quickly due to the cut, but no real strong evidence that those in their 20s did. So, and they discussed that that's probably likely due to the fact that there was just a lack of employment opportunities in general at the time. So of course, one policy option that we highlight would be to protect younger people's entitlements and incomes and align the job seekers allowance rates for those over and under 25, given that they didn't seem to have strong evidence that it actually increased youth employment. It would cost around 159 million per annum, which would be around an 8% rise in unemployment support, but it would primarily benefit the very bottom income quintile where we tend to find young people. And also that cost would come down now because, as I said, we did this analysis at a time of higher unemployment. As youth unemployment declines, the cost would be reduced as well. Student supports, and something that is very, very topical at the moment. There's lots of debates going on around student supports and access to services, which I'm sure you're very well aware of in UCD. The PUP was withdrawn for students in September. And if we look back at how many students were reliant on this, well, in April 2021, the CSO estimate that at least a third of PUP recipients aged under 25 were registered full-time students. So this is why we see, if the PUP hadn't been brought in, why there would have been much sharper income losses for the 18 to 24 and particularly those groups in education, because they just wouldn't have been entitled to any other unemployment benefits. So while you could argue that combining work and study can be beneficial, research by the OECD has found that it's likely to be more beneficial if employment and education are linked in some way. So for example, in countries like Austria, Germany, Denmark, over half of students who are working are doing so formally through linked to their education, things like apprenticeships or vocational education and training. And it's less than a quarter in Ireland. So in Ireland, it tends to be less related to sort of linking employment and education and more, doing it out of necessity. So an Irish League of Credit Union survey before the pandemic found that 3/4 of third level students reported working just to cover costs. Over half reported missed in lectures to work, with 16% reporting that work had a negative impact on their studies. So of course, while students aren't eligible for unemployment supports if they can't find a job, there is a means tested payment, so we know it as the grant, that does exist for students. However, research by IGIS researchers has found that in recent years, the number of students qualifying for grant has fallen, despite there being a rise in third level attendance. And basically this is down to the fact that it's a means tested scheme, and there's different rates paid depending on generally your parental income. So what's happened is that those income points, or the means for the grant, the levels or the cutoffs for the different rates of the grant haven't risen in line with inflation. So there has been very little change in the last few decades, basically, in the actual income cutoff points for which people can qualify for grants, which has resulted in a fall of the number of people entitled. As well as issues with entitlement to grants at all, there are issues around sort of adequacy of the rate of grant. So in the early 1970s, the rate of the student grant was roughly equal to the rate of unemployment payments. And I can understand the rationale for this, because unemployment payments are sort of seen as a minimum amount that, a minimum income that people can survive on for a sort of basic standard of living. So that having the student grant at this rate for people who qualified, sort of makes sense. We see it in other countries, in Sweden, in Australia. The rate of student grants is basically equivalent to the rate of what students could get on unemployment payments. However, if we look at what's happened in Ireland, by 2006, unemployment benefits were over 7 times higher than the grant level. And it's really reflecting the fact, similar to the income limits for the grant, the actual rates of the grant, or the amounts of the grant, have not kept pace with inflation. So they've tended to stagnate over very long periods of time, which means that if we look now, the maximum rate of the current grant, it's just over half of the equivalent unemployment support. And I think most students who qualify for the grant actually get the next rate down, so that's lower again. So obviously, in terms of policy options, increasing the grant levels closer to unemployment payments would help protect the incomes of students who qualify. And if they are to be changed as well, to ensure that rates and incomes keep pace with inflation, so that we don't get this sort of erosion of entitlement and of rates that we've seen over time in the last few decades. Then in terms of the rates or the level of job seeker supports that are there, we've seen that the PUP has higher rates of payments and a much stronger link to previous earnings than does job seekers benefit. And in one way, this highlights inequities between people who lost their job just before the pandemic, who would be entitled to the old payments, and people who lost their jobs during the pandemic. And as the pandemic has sort of dragged on now for coming up to close to 2 years soon, it really is sort of highlighting inequities between those two groups. If we look to our European and OECD neighbours, we see that most of those countries have much stronger links between pre-employment earnings and initial unemployment benefits, whereas in Ireland, the shorter term unemployment payment, the job seekers benefit, and the longer term payment, job seekers allowance, they have the same maximum rate of €203. So there's really no distinction made between short and long-term benefits, and there's no real link back to previous earnings either. And linking back benefits to previous earnings acknowledge the fact that it can be difficult for people to adjust spending in the shorter term. So for example, people tend to have housing costs that they can't reduce in the short term. As well, having higher benefits in the shorter term allows people to, some time to search for a job, to maintain their income, to search for a job that's, linked or that is close to what they would have been earning before, and has a wage that reflects their skill levels, and it gives people time to search and to find positions. So, and obviously another policy option we highlight in the paper is to strengthen the link between job seekers benefits rates and pre-job loss earnings, so that job seekers benefit provides more income support in the shorter term. And we've seen that with the pandemic unemployment payment, that people's incomes were more cushioned right up the income distribution than would have been the case if those schemes hadn't been introduced. And then the sort of final issue that I think the pandemic has highlighted is that we might face higher underemployment going out into the future as we recover, hopefully, from the pandemic, which might mean that we need more in-work supports. So it's likely that the line between working and unemployment may remain more blurred as the economy recovers. So here, if we look back to the Great Recession, that stopped working, there we go. If we look at the numbers of people who report that they're working part-time, we see a bit of a rise over the Great Recession. So going from sort of 15 to over 20% by 2013, and then coming back down as the economy recovers. So a relatively small rise in part-time employment. But if we look at what proportion of part-time unemployment or part-time employment was involuntary, so basically people say they're working part-time because they can't find a full-time job, there was a huge rise in this over the Great Recession. So between 10 and 15% of people working part-time said they were doing so involuntarily before the Great Recession. It rises to over 40% by 2013, and improves as the economy recovers, right up to before the pandemic. So it's highly likely that we might see this scenario as we recover from COVID. Hopefully we won't see it as extreme or lasting as long, if the economy can recover more quickly than it did during the Great Recession. So what protections do we have for people who are underemployed? What in-work supports exist? So there is a range of different supports at the moment. The short-time work scheme is there. I have to admit, I haven't really heard of this before I started looking into it. But basically it will top up people's incomes if their hours are reduced. So if somebody was working 5 days a week and now they're only working 3, then they can get the short-time work scheme to cover those 2 days they're unemployed. However, there is a generosity issue. So basically it's still only paid at a maximum weekly rate of that €203. So the maximum rate of unemployment benefits. And these schemes have been credited in Germany with, really helping the German economy rebound after the Great Recession. But the research there shows us that the more generous the schemes are, the more likely people are going to use them. So that generosity issue is going to probably be an issue if we want to actually expand the use of the work scheme in Ireland. There's this strange rule in job seekers assistance and job seekers benefit in which you can be partially employed or partially unemployed and still receive some of the benefit prorated, but it's called the 4 and 7 rule. So basically you have to be unemployed for 4 out of 7 days in order to get it. And I think this rule really presents a rigidity for employers and employees. So if we think about it, we could have 2 workers who are working 15 hours a week. One of them works 5 days a week, 3 hours a day. And you can imagine this might fit with people, say, whose kids are in school and wouldn't need childcare over that time. So they may want to work that pattern, or their employer may need them to work that pattern. And then if we take somebody who works 15 hours a week, but works it all in 2 days, well, the first person who spreads the hours out over the week can get no top up from unemployment supports. Whereas the other person whose hours are concentrated in a couple of days can receive the scheme's prorated. So we can imagine, if we think about the industries that have faced large job losses over the pandemic, so hospitality, retail, often there's a need for greater flexibility. So people don't have sort of fixed work hours or days, and employers may want people or need people at certain times of the day or certain days of the week. If this rule continues, then it's going to possibly cause issues or cause a disincentive for people to take up employment. So while you can currently get job seekers assistance or job seekers benefit prorated for a week, that's not the case with the pandemic unemployment payment. So while I said earlier, the pandemic unemployment payment hasn't worsened financial work incentives hugely, and it's done so because it's providing higher income support. But one issue that we do highlight in the report is the fact that if you take up 1 hour of employment, you lose your full entitlement pandemic unemployment payment. You can't keep it partially. So that might present a work disincentive. It was recognised this was the case for people who were self-employed getting the pandemic unemployment payment, and there was actually a sort of income disregard brought in. So self-employed people could earn a certain amount and still keep the payment. So that is one feature of PUP that might be problematic as we emerge from the pandemic. There are other in-work supports for those on low income. So the main one in Ireland is known as the Working Family Payment. And this basically provides an income top-up to low-income people who are working a certain number of hours a week, but you have to have children in order to qualify. And even amongst people who do qualify, research over the last number of decades has shown there's take-up issues with this scheme. So you have to go and actually, apply for the scheme directly to the Department of Social Protection. And we've seen that there have been take-up issues with this scheme. In terms of only being available to those with children, this is, quite unusual. Most countries that have these in-work supports provide a benefit to both to those people with or without children. And we saw from the tables I presented earlier that singles and couples without children are 2 groups that stand out as having potentially very large income losses if the pandemic unemployment payment or wage subsidy are removed. So there's no sort of in-work supports for them. And you can imagine that might create some work disincentives there. So we discussed various policy options to tackle the issue of underemployment in the report, increasing the generosity of the short-term work scheme, changing the 4 and 7 rule to something like an earnings disregard. So most or all other payments, social welfare payments in Ireland that allow you to combine social welfare receipt and earnings. So for example, disability allowance, one parent family payment. Those schemes allow you to earn a certain amount and keep the full payment, and then it's tapered down gradually. So they don't face this sort of anomaly that the 4 and 7 rule presents. In terms of other policy options, trying to increase take-up of the Working Family Payment Scheme or extend the scheme to childless and individual couples could help to strengthen work incentives for certain low-income people. And extending the working family payment to childless or individual couples would particularly improve the income or increase the income of the very lowest income quintile. So I've talked quite a lot about how we could spend more money and how we could make the system more generous. How do we fund this? And this isn't something we really get into in the paper. There's another piece of work that was released at the same time and looks at lots of different ways of how you could increase taxes and, where the potential is there. But I do think that now is sort of an interesting time in social welfare analysis to sit back and think, we've just talked through why is it we needed these additional payments? What was sort of lacking in the pre-existing social welfare system, and why did the extra payments have to be introduced? In order of funding these, anything that increases the generosity or coverage of safety nets will of course come at a cost. And the pandemic unemployment payment and wage subsidy have been based on borrowing. So low interest borrowings facilitated by the European Central Bank, but borrowings nonetheless. So realistically, if we're going to increase the generosity or coverage of safety nets, then we would need some form of tax or social insurance increases. I'm naive in thinking this, but I do think there's maybe more demand for government support and perhaps more willingness to pay taxes. So OECD, the Risks That Matter survey carried out in 2021 found that both amongst households where somebody lost a job due to the pandemic and households where somebody didn't lose a job due to the pandemic, people were very worried about their future and their future financial, social and economic well-being. So 81% of respondents who lost a job felt they were worried about the future and the next year or two. Still 65% of people who didn't experience a job loss in the household say that they were somewhat or very concerned about their economic well-being going out into the future. In terms of taxes and potentially paying for a stronger safety net, the report across all OECD countries, including Ireland, finds stronger demand for government income support, but also a willingness to pay higher taxes to fund them. So people were asked, bearing in mind the implications for the taxes they'd have to pay, i.e. that they would go up. You had 60% of respondents on average saying of those where there'd been a job loss in the household, saying that they would basically be willing to pay more taxes to get better government income support, particularly unemployment supports. And it was still 48% of respondents where there was no household job loss. So I do think that now there might be a bit more appetite for change, rather than the annual thing of every budget us getting a couple of euro back in tax cuts, that actually people may be willing to pay more to have stronger income support. And I do think as well, if we're looking at it, I think there's been quite a lot of discussion about linking back unemployment benefits to previous earnings. So there might be more of a willingness for people to pay more if they think they're going to be more protected by the social welfare system if they lose their job. So I'll finish up with some conclusions, and I'm happy to take questions. So overall, we find that the social welfare system did, quite a good job in supporting incomes during the pandemic. So the introduction of the pandemic unemployment payment and wage subsidy helped to halve the losses that would have been experienced in their absence. We do see a slight weakening of financial work incentives, but this is reflecting the fact that the pandemic unemployment payment has a stronger income support for people higher up the income distribution. We see that certain groups are at risk of larger losses as these schemes wind down. So younger people, including students, those of working age without children, and working age couples with children also. In terms of policy options, we discussed how increasing youth rates of job seekers allowance and increasing grant levels, which have very much fallen behind equivalent unemployment benefits over time, could be looked at, and that we may need more income in work support. So it's likely that we don't maybe return straight away to a situation of full employment in terms of numbers, or in terms of part-time versus full-time working. So that in work supports, things like extending working family payment to the people without children, trying to increase take-up, and strengthening the generosity of the short-term work scheme could be ways to tackle these issues. And it might be an optimal time to make changes while people are still perhaps willing to pay more in order to get more protection from the state. Okay, so that's it from me.